There is a tax rate that most retirees have never heard of. Not 15%, not 20%, 28%, and it is hiding inside the home you have lived in for decades. Not in the mortgage, not in the property taxes, not in anything your real estate agent will ever mention when they sit across from you at the kitchen table and tell you what your home is worth. It is hiding in a specific type of gain that the IRS treats completely differently from everything else. And the retirees who discover it are not discovering it before they sell. They are discovering it on their tax return the following April when the bill has already been calculated and there is nothing left to do but pay it. Right now in 2026, home values across America are at levels most homeowners never imagined when they bought their properties. A house purchased for $90,000 in 1987 is worth $480,000 today in many markets. A home bought for $140,000 in 1995 is selling for $550,000 or more. That appreciation feels like pure profit, and most of it is. But buried inside that gain, invisible unless you know exactly where to look, is a portion that the IRS taxes at 28%. Not the standard long-term capital gains rate of 15% that most people plan for, 28%. And the difference between planning for 15 and actually owing 28 is not a small rounding error. On a $100,000 gain, it is $13,000 in unexpected taxes. On a $200,000 gain, it is $26,000. Money that leaves your retirement permanently. Money that was supposed to fund your next chapter. Gone because nobody told you this rate existed before you signed the listing agreement. By the end of this video, you are going to know exactly what triggers the 28% rate, why it applies to so many retirees selling homes they have owned for decades, the specific calculation the IRS uses that most tax preparers miss until it is too late, and the steps you can take right now before you sell to reduce or eliminate it completely. None of this requires you to be a tax expert. It just requires you to know it exists before you sell, not after. Before I go any further, let me be clear. I am not a lawyer. I am not a CPA. I am not your financial advisor. Everything in this video is educational, drawn from publicly available IRS code, tax guidance, and real estate tax rules current to 2026. Your situation is your own. Always work with a qualified tax professional before making any decisions about selling your home. My name is Kevin, and this channel exists for one reason: to take the tax rules that sit buried in IRS publications that nobody reads and bring them to you in plain English before they cost you money. If that is useful to you, subscribe right now, because what I am about to explain is something most retirees will never hear from their real estate agent, their financial advisor, or even their accountant, unless that accountant specializes specifically in real estate taxation, and most do not. Let me start with the thing that almost nobody explains clearly. When you sell your home, not all of the gain is the same. Most people think of home sale profit as one simple number. You bought the house for this, you sold it for that. The difference is your gain. But the IRS does not see it that way. The IRS splits your gain into categories, and different categories are taxed at different rates. The category that triggers 28% is called Unrecaptured Section 1250 gain. That name sounds complicated. The concept behind it is not. Here is what it means in plain English. Every year you own a home, the IRS allows certain deductions related to the property. If you ever rented out part of your home, operated a business from it, or used a portion of it as a home office and claimed depreciation deductions, the IRS gave you a tax benefit in those years. It let you deduct a portion of the property's value as it theoretically wore down over time. That is called depreciation. And the IRS was generous with that deduction while you were taking it. But the IRS has a long memory. When you sell the home, it wants that benefit back. Every dollar of depreciation you claimed over the years gets recaptured. And the recaptured amount is taxed, not at the standard capital gains rate of 15%, but at a maximum rate of 28%. That is the trap. And here is what makes it so dangerous for retirees specifically. You do not have to have intentionally claimed depreciation to be caught by this rule. If you rented out a room in your home for any period of time, depreciation applies. If you had a dedicated home office for a business and claimed the home office deduction on your taxes, depreciation applies. If you ever operated a bed and breakfast or short-term rental through any platform, depreciation applies. And here is the one that catches the most people completely off guard. If a prior tax preparer claimed depreciation on your behalf and you simply signed the return without understanding every line, you may have years of accumulated depreciation sitting in your tax history right now that you have completely forgotten about. The IRS has not forgotten. The IRS tracks every dollar of depreciation ever claimed against your property, and when you sell, every single dollar of it comes back as unrecaptured Section 1250 gain, taxed at up to 28%. You do not get to say you did not realize it was being claimed. The return was signed. The deduction was taken. The recapture is owed. Let me make this real with someone you can picture. I want you to meet Donald. Donald is 72 years old. He is a retired engineer living in North Carolina. He bought his home in 1993 for $105,000. For 11 years, between 1998 and 2009, Donald rented out the basement apartment to a tenant. It helped cover the mortgage when his kids were young and money was tighter. His accountant at the time did everything correctly. The rental income was reported. The depreciation on the rental portion of the home was claimed each year. It reduced Donald's taxable income during those years and saved him real money. Donald has not thought about that basement apartment in 15 years. His home is now worth $520,000. His daughter has been encouraging him to sell, downsize, move closer to the grandchildren, and enjoy the equity he has built. Donald calls a real estate agent. The agent tells him he will clear roughly $415,000 after the mortgage payoff and closing costs. Donald is excited. He pictures that money going into his retirement accounts, funding travel, maybe helping his daughter with a down payment. He lists the home. It sells in 3 weeks. Then April comes. His new tax preparer, seeing the sale for the first time, asks Donald if he ever claimed depreciation on the property. Donald says he thinks so, years ago, but he is not sure of the details. The preparer pulls the numbers. Over 11 years of rental use, the depreciation claimed on the rental portion of the home totaled $38,400. That $38,400 is Unrecaptured Section 1,250 gain. It is taxed at 25% in Donald's bracket, not 15%. The difference between 15% and 25% on $38,400 is $3,840 in additional tax. But that is not the end of it, because Donald's total gain from the sale also pushed his adjusted gross income well above normal for the year. That spike triggered IRMAA surcharges on his Medicare premiums. It pushed more of his Social Security into the taxable tier, and it phased out a senior deduction he had been counting on. By the time every consequence of that single sale year worked through his tax return, Donald owed $19,200 more in combined federal taxes than he had budgeted for. He had planned carefully. He had worked with an accountant for decades, but nobody had ever sat him down and explained the unrecaptured depreciation rule before he sold. And that is the gap this video is closing for you right now. Now let me explain the calculation the IRS uses, because understanding it is what gives you the power to reduce it. When you sell your home, the IRS calculates your total gain first. Take your selling price, subtract your original purchase price, subtract any major capital improvements you made over the years. That gives you your total gain. Then the IRS looks at your depreciation history. It identifies every dollar of depreciation ever claimed on that property through rental use, home office deductions, or any other qualifying business use. That amount is carved out of your total gain and labeled Unrecaptured Section 1,250 gain. It is taxed at a maximum rate of 25% for most retirees. In certain higher income situations, it can reach 28%. The remaining gain above that carved out amount is your standard long-term capital gain, taxed at 0, 15, or 20% depending on your income. And then on top of all of that sits the Section 121 exclusion. If you have lived in the home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain as a single filer, or up to $500,000 as a married couple filing jointly. But here is the critical detail that most people miss. The Section 121 exclusion does not eliminate the unrecaptured depreciation. It reduces your total gain. But the depreciation recapture comes off first, before the exclusion is applied to the remainder. Let me show you the math clearly. Say your total gain is $320,000. You have $42,000 in accumulated depreciation from years of home office use. That $42,000 is unrecaptured Section 1,250 gain, taxed at up to 25%. That is a potential tax of $10,500. The remaining $278,000 is standard long-term capital gain. Your $250,000 single filer exclusion applies to that remaining amount. $278,000 minus $250,000 exclusion leaves $28,000 still taxable at standard long-term capital gains rates. So your total tax bill has 2 parts: $10,500 on the depreciation recapture, plus whatever you owe on the $28,000 of standard gain. If you had never claimed depreciation, your $250,000 exclusion would have wiped out most of your taxable gain entirely. But the depreciation you claimed years ago is sitting there, waiting to be recaptured, sitting outside the protection of your exclusion. That is the trap. And now let me tell you the part nobody gets to hear before they sell. There are specific steps you can take before listing your home that can reduce this bill significantly. The first step is to pull your complete tax history. Go back and find every return you or your tax preparer filed while you owned the home. Look specifically for Schedule E, which covers rental income and depreciation. Look for Form 8829, which covers home office deductions. Look for any year where depreciation was claimed against this property. Add up the total depreciation claimed across every year. That number is your unrecaptured gain exposure. That is the amount that will be taxed at the higher rate. Knowing that number before you sell means you can plan for it, budget for it, and explore strategies to offset it, rather than discovering it cold on a tax return. The second step is to calculate your net after-tax proceeds before you agree to list. Most retirees negotiate the selling price, agree to terms, sign the listing agreement, and then find out what they actually keep after taxes. That is backwards. You need to know what you actually keep before you commit to selling. Take your expected selling price. Subtract your remaining mortgage if you have one. Subtract the real estate commission, typically 5 to 6%. Subtract closing costs, typically 1 to 3%. Subtract your estimated capital gains tax on the standard gain, and subtract your estimated depreciation recapture tax separately. What remains is your true net proceeds. For many retirees, that number is significantly lower than the equity figure their agent quotes them. It needs to be real before you sign anything. The third step is to talk to a CPA who specializes in real estate transactions before you list, not after you sell, before. A qualified tax professional can model the exact tax consequences of your specific sale, identify any depreciation in your history you may have forgotten, determine whether any installment sale strategies could spread the gain and the resulting tax liability across multiple years, and advise on whether a 1031 exchange into a rental or investment property could defer the depreciation recapture entirely. These strategies exist. They are legal. They are used by informed sellers every day. But they require planning before the sale closes. The moment the sale is final, the options narrow dramatically. The fourth step is to maximize your cost basis before you sell. Every major capital improvement you made to the home over the years increases your cost basis and reduces your taxable gain dollar for dollar. New roof, new HVAC system, kitchen remodel, bathroom addition, new windows, major landscaping, room additions. Every one of those expenses, if you have documentation, reduces the gain the IRS can tax. Gather every receipt, every contractor invoice, every permit, every record of major work done to the home since you bought it. Many retirees have tens of thousands of dollars in improvements they have simply forgotten about or never organized. Each dollar of documented improvement is a dollar the IRS cannot tax. And the fifth step is to understand the timing of your sale relative to your other income. In the year you sell your home, your adjusted gross income will spike dramatically. That spike affects multiple calculations simultaneously. It affects how much of your Social Security is taxable. It affects your Medicare IRMAA surcharges, which do not arrive until 2 years after the sale. It affects whether you qualify for senior deductions that phase out at higher income levels. And it affects your overall federal tax bracket for that entire year. If you have any control over the timing of when you close, your tax professional can model whether closing in December versus January or in 1 year versus the next meaningfully changes your total tax liability. A difference of a few weeks in closing date can sometimes save thousands of dollars simply by shifting the taxable income into a different calendar year. Now let me tie this together because I want you to leave with a clear picture. The 28% trap is not a punishment. It is not a penalty. It is not the IRS targeting retirees unfairly. It is simply a rule that has been in the tax code for decades, a rule that applies automatically when certain conditions are met, a rule that does not care whether you knew about it or not. And the retirees who pay the highest price are not the ones who made bad decisions. They are the ones who made perfectly reasonable decisions, renting a room, running a home office, building a business from home, without anyone ever explaining what those decisions would mean at the moment of sale. The information existed. It was always in the tax code. But nobody translated it into plain English and put it in front of you before it mattered. That is what changed today. You now know the 28% rate exists. You know what triggers it. You know the specific calculation the IRS uses. You know the 5 steps you can take before you sell to reduce or eliminate it. And you know that the time to take those steps is before you sign the listing agreement. Not after. Not on the April following your closing. Before. Here is what I want you to do this week. First, look back through your tax returns for any year you claimed a home office deduction or reported rental income from your property. If you find either one, calculate the total depreciation claimed across every year. That is your exposure number. Write it down. Second, call your CPA or a real estate tax specialist and ask specifically about unrecaptured Section 1,250 gain on your property before you list it. Use that exact phrase. If your tax professional looks confused or has not brought this up proactively, that is a signal to find someone who specializes in this area. Third, gather every record of major capital improvements made to your home since the day you bought it. Organize them. Total them up. Every dollar of documented improvement reduces the gain the IRS can reach. Those 3 steps cost you nothing but time, and they could save you more money than you spent on your home's original down payment. Before I let you go, let me ask you something directly because your answers shape every video I make next. Before today, did you know that home office deductions and rental income could create a tax bill at the higher 28% rate when you sell your home? Type yes or no in the comments right now. And tell me this, have you ever rented out any part of your home or claimed a home office deduction on your taxes? Just type rent, office, both, or neither. I read every comment, and the answers tell me exactly which part of this to go deeper on in the next video. Now think about one person you know who is planning to sell their home in the next year or two. A neighbor who has been talking about downsizing. A sibling who mentioned listing their house this spring. A friend whose children have been encouraging them to move closer. Picture their face. Then send them this video today before they sign anything. Because the listing agreement takes minutes to sign, and the tax bill it creates can follow a retiree for years. That is what this channel is here to prevent. If this helped you, hit the like button and subscribe so the next warning reaches you before the next deadline does. I will see you in the next one. Stay safe and protect every dollar you have spent a lifetime building.